one of the things that we should talk about is what an owner can expect today, how that's a little bit different than years prior, and what kind of role they should expect to play on a going forward basis, but also how they can anticipate that the deal might be structured around their ongoing role and participation with the company on a going forward basis.
Service-based businesses, for the most part, are going to be valued on a multiple of adjusted EBITDA, or call it adjusted earnings, adjusted for owner expenses that might not exist post-transaction, and other non-recurring expenses. Now, the actual multiple ranges really haven't changed significantly over the last 12 to 18 months at all. But what has changed over the past few years is the amount and type of deal structure that's being incorporated into these transactions.
I agree with you. I think it's important to note that while the multiples may vary, and certainly the structure of these transactions may vary, over the years that we've been involved in this marketplace and certainly have watched the trends, one thing has remained very, very consistent. For these service businesses, you need to pull out debt buyers, which we'll talk about momentarily, but for service businesses, the ARM companies, the contingency operations, the first-party operations, the collection agencies, for the most part, what we're looking at there is a multiple of adjusted EBITDA. As you said earlier, and that multiple might vary, but the common denominator that really continues is what the buyer bases the valuation matrix on in all of these instances.
That's right. And the type of deal structure that we're seeing predominantly is in the form of either an earn-out where an owner of the company will get a part of the value in cash at closing, but they'll also get part over time based on sustainability, improved performance, retention of clients, all those types of things. But we're actually seeing an increase in the use of what's called a seller's note. Now, a seller's note is interesting because it actually is a better guarantee than an earn-out, but yet it gets paid out over time. Now, for a seller, that could be great for a couple of reasons. Number one, it's less risky. I mean, it's tied to the actual company, but it's less risky. Number two, for tax purposes, depending on what kind of corporate structure they have, that could be very beneficial.
For mid-size and certainly larger size transactions, we're seeing more owner participation on a going forward basis as well. It's not unusual for either them to, the existing owner, to sell some percentage of their business, in most cases controlling interest in their business, in some cases maybe a minority investment in their business, but retain ownership on a going forward basis, or have to buy back in at some level on a going forward basis with the new owners and the buyers, and participate in that activity until some other change of ownership event might take place down the road.
Right, and actually, as I was thinking about it, I should let everyone know that if they want to learn more about the valuations and deal structure, I actually wrote a blog recently where I put out a matrix that shows what the valuation ranges look like and talk a little bit about deal structure. There's an upcoming blog that will get more into the deal structure side.